What if I told you there's a way to buy an ugly, rundown house, fix it up, and then sell it for a big profit without having to use a single penny of your own savings? Sounds almost too good to be true, right? Well, that's exactly the promise behind something called a fix and flip loan. But here's the thing. While these loans can be a golden ticket for new real estate investors, they can also be a financial trap if you don't know exactly how they work. By the end of this video, you'll not only know how these loans function, but you'll also discover the one mistake that makes beginners lose money fast. Stick around, because once you hear it, you'll never forget it. Number 1. What exactly is a fix and flip loan? A fix and flip loan is short-term financing that helps investors purchase and renovate properties before selling them for a profit. Think of it like a bridge loan. It gets you from point A, buying the house, to point B, selling it for more. These loans usually last between 6 months and 18 months because they're not meant for long-term ownership. For example, if you find a house selling for $120,000 but it needs major repairs, a fix and flip loan can provide the money you need to buy it and fix it up before you sell it for maybe $200,000 or more. The key is speed. These loans are designed for quick turnarounds. Number 2. Who offers fix and flip loans? Most traditional banks don't hand these out easily because they see them as too risky. Instead, private lenders, hard money lenders, and sometimes online lending platforms are the ones who provide them. For instance, you might find a local hard money lender who specializes in lending to house flippers in your city. They're more flexible than banks, but that flexibility comes with higher costs. We'll talk about those costs in just a moment. Number 3. How much money can you borrow? Here's where it gets interesting. Lenders usually base the loan amount on something called the ARV, which means after repair value. That's how much the property is expected to be worth once the renovations are complete. Typically, lenders will finance up to 70% of the ARV. Let's use an example. Say a house will be worth $200,000 after you fix it up. The lender may approve up to $140,000 for the loan. That amount can cover both the purchase price and renovation costs. But you'll still need to put in some of your own money, especially if the purchase price plus repairs go above that limit. Number 4. How do the loan terms work? These loans are short, usually between 6 months and 18 months. Interest rates are higher than a normal mortgage, often in the range of 8% to 15%. Some lenders might also charge upfront fees known as points, where 1 point equals to 1% of the loan amount. For example, if your loan is $100,000 and the lender charges 2 points, you'll pay $2,000 upfront just to get started. This means fix and flip loans are more expensive than a traditional mortgage. But remember, you're paying for speed and flexibility. Number 5. What can you actually use the money for? Most fix and flip loans can be used for both the purchase of the property and the renovation. Let's say you buy a small house for $90,000 and the repairs are expected to cost $30,000. If the lender approves $120,000, you can use it for both the purchase and the renovations. The money might not come as one big check, though. Sometimes lenders release renovation funds in stages. This way, they know you're actually making progress before giving you more cash. Number 6. Why do people use fix and flip loans instead of cash? The simple answer is leverage. Let's imagine you only have $50,000 in savings. Without a loan, you could only buy one small property to flip. But with a fix and flip loan, you could possibly take on 2 or even 3 projects, multiplying your potential profits. It's like using the bank's money to supercharge your investing. Of course, the risk is also multiplied. If the market shifts or the renovation costs spiral out of control, you could lose big. Number 7. What are the risks you need to watch out for? This is the part where many beginners stumble. One of the biggest risks is underestimating the renovation costs. Let's say you think the bathroom remodel will cost $5,000, but it ends up costing $15,000. Suddenly, your profit margin shrinks. Another risk is the market itself. If home prices in your area drop during your project, you could end up selling for less than you expected. And don't forget the interest clock is ticking. Every month you hold on to the property, you're paying more in loan costs. Time really is money here. Number 8. How do you qualify for a fix and flip loan? The good news is lenders don't just look at your credit score like a regular mortgage. They're more interested in the deal itself. If the property has strong profit potential, you stand a better chance. But many lenders still want to see that you have some experience in real estate or construction. If you're a total beginner, you may need to partner with someone who has experience, or you might pay a higher interest rate until you prove yourself. Lenders want confidence that you can actually finish the project and sell. Number 9. What does the step-by-step process look like? It usually goes like this. First, you find a property that seems like a good deal. Second, you calculate the ARV and estimate renovation costs. Third, you apply with a lender, providing all your numbers. Fourth, once approved, you buy the property using the loan. Fifth, you complete the renovations, often with funds released in stages. And finally, you sell the property, repay the loan, and keep the profit. It sounds simple on paper, but each step has challenges. For example, if contractors delay the renovation, your loan costs climb higher with every month of delay. Number 10. The golden rule. For beginners, here's the part one promised you earlier. The mistake that kills beginner flippers is overestimating the ARV or underestimating costs. In other words, they dream too big and spend too little time researching. If you think a house will sell for $220,000, but the market only supports $180,000, you're in big trouble. The golden rule is this: always run your numbers conservatively. Expect repairs to cost more and profits to be less. If the deal still looks good, even with those cautious numbers, then you've probably found a winner. Professional flippers always work with margins of safety, and so should you. Number 11. Example of a real fix and flip deal. Let's bring this to life. Imagine Sarah, a beginner investor, finds a small house listed for $100,000. The house needs about $40,000 of work, and she estimates the ARV to be $180,000. Her lender agrees to give her a $120,000 loan based on 70% of ARV. Sarah puts in $20,000 of her own savings to cover the gap. After 4 months of work, the house sells for $182,000. She pays back the loan plus $6,000 in interest and fees, leaving her with a profit of about $16,000. Not bad for a beginner's first project. Number 12. Tips to succeed with fix and flip loans. Tip 1. Always add extra time and money into your renovation budget. If you think it will take 3 months and $20,000, plan for 4 months and $25,000. Tip 2. Build a reliable contractor team. A good contractor can save you thousands of dollars and weeks of time. Tip 3. Research your local housing market like crazy. A great renovation in the wrong neighborhood can still flop. Tip 4. Network with lenders before you find a deal. Having financing lined up makes your offer stronger and faster. Number 13. Is a fix and flip loan right for you? If you're comfortable with higher risk, love real estate, and are willing to learn fast, then yes, a fix and flip loan could be the perfect tool. But if you prefer slow, steady, low-risk investing, you might be better off with rentals or REITs. The truth is, fix and flip loans are like race cars. They're fast, powerful, and exciting, but you need skill to drive them without crashing. Number 14. How do fix and flip loans get repaid? Unlike a traditional mortgage where you pay monthly principal and interest, many fix and flip loans only require you to pay interest during the term. The full balance is then paid off once the property is sold. For example, if your loan is $120,000, you might pay $1,200 in monthly interest while you work on renovations, then repay the $120,000 after the sale. This helps keep your cash flow manageable while the project is in progress. Number 15. Can you refinance a fix and flip loan? Yes, some investors choose to refinance into a longer-term loan if the project takes longer than expected. For instance, if you plan to sell within 6 months, but the market slows, you might refinance into a standard mortgage to buy more time. This strategy prevents you from defaulting on the short-term loan, though it often comes with extra costs. Number 16. What happens if the property doesn't sell? This is the nightmare scenario. If your property doesn't sell before the loan term ends, you could be forced to pay penalties, refinance, or in the worst case, risk foreclosure. Lenders may repossess the property to recover their money. That's why having an exit strategy is just as important as buying the property in the first place. Number 17. What is a draw schedule and why does it matter? Many lenders don't give you all the renovation money up front. Instead, they use something called a draw schedule. This means you receive funds in chunks as specific renovation milestones are completed. For example, after plumbing and electrical work is done, the lender releases the next portion of money. This protects the lender from giving too much cash before progress is proven, and it keeps you accountable. Number 18. Can you use fix and flip loans for rental conversions? Surprisingly, yes. Some investors use these loans not just to sell, but to fix up a property and then refinance it into a rental mortgage. Imagine buying a rundown duplex with a fix and flip loan, renovating it, and then refinancing into a 30-year mortgage. Now you've got a cash-flowing rental property with built-in equity. This is often called the BRRR method: buy, rehab, rent, refinance, repeat. Number 19. How does location affect success with these loans? The location of the property can make or break your deal. A beautiful renovation in a neighborhood with weak demand won't sell fast, and every extra month costs you more in interest. For example, flipping in a growing suburb with new schools and businesses is often much safer than flipping in a stagnant area with high crime rates. Location can be just as important as the numbers themselves. Number 20. Are fix and flip loans available to people with bad credit? Some lenders do approve loans for people with poor credit scores, but the terms will be tougher. You might face higher interest rates, larger down payments, or stricter conditions. However, if your project is a strong deal, lenders may overlook credit issues because they're primarily betting on the property's future value, not just your credit history. Number 21. Do fix and flip loans cover closing costs? Sometimes they do, but often they don't. Closing costs such as title insurance, appraisal fees, and legal paperwork can add up to thousands of dollars. For example, if you're buying a $100,000 property, you might face $3,000 to $5,000 in closing costs. You'll need to budget for these expenses separately to avoid last-minute surprises. Number 22. How fast can you get approved for these loans? Approval speed is one of their biggest advantages. While a traditional mortgage can take weeks, many hard money lenders can approve you within a few days, and sometimes within 24 hours. This speed is crucial when you're competing with cash buyers at auctions or trying to secure a hot property before someone else does. Number 23. Do lenders inspect the property during the project? Yes, many do. Lenders often send inspectors to verify that renovations are happening according to plan. For example, if you've requested the next draw of funds, the lender might send someone to check that the roof replacement is complete before releasing more money. This protects the lender, but it also ensures you stay on schedule. Number 24. Can you use fix and flip loans on auction properties? Definitely. In fact, that's one of the most common uses. Auction properties often need major repairs and can't qualify for traditional mortgages. A fix and flip loan gives you the quick cash to buy at auction, renovate, and then sell at market value. The speed and flexibility of these loans make them perfect for competitive auction settings. So now you know what fix and flip loans are, how they work, the risks to avoid, and the golden rule that separates profitable investors from broke ones. The next time you see a rundown property on the corner, you'll look at it in a whole new light. Imagine what it could be worth after the right renovations. Would you take the leap and try a fix and flip loan, or does the risk still feel too high for you? Let me know your thoughts in the comments.